Hello everyone, we are the Stock Up Finance team and we are back again with another video on the financial basics. This time we are going to focus on the core of the financial analysis and that is understanding the financial statements. By definition, financial statements are written records that provide information to outsiders regarding the financial performance and health of the company over time. This helps in gaining insight in how the companies work and identify the company's strengths and weaknesses. These statements are helpful for current and future investors, creditors, and lenders in the valuation of the company or making investment decisions in companies, whether to give credit to the firm or not, etc. There are three types of financial statements, namely the balance sheet, income statement, and the cash flow statement. We will discuss these statements separately. The first statement is the most important of all the financial statements, which is the balance sheet. It captures the financial position of a company as of a particular date and lists out what the company owns in assets and what it owes in liabilities. Balance sheet has three parts, namely assets, liabilities, and shareholders' equity. Assets define what the company owns, liabilities define what it owes outside the company, and shareholders' equity means how much shareholders have invested in the company. Assets represent the resources owned by the company and are used to generate economic benefits in the future, like higher cash flows. Examples of assets are cash and cash equivalents, inventory, property, plant, machinery, and intangible assets like patents and trademarks. Liabilities represent what the company owes to the outsiders. That is, the company's obligations to the outsiders. Example of liabilities are accounts payable, short-term and long-term loans, etc. The third part of the balance sheet is the shareholders' equity. This represents the owner's investment in the company and aggregate undistributed profits called retained earnings. The balance sheet must balance out at all times. That is, assets must equal liabilities plus shareholders' equity. Assets represent how the company uses its resources, whereas liabilities and shareholders' equity represent where the company gets its resources from. These must equal each other at all times. One of the most important things to remember about the balance sheet is that all items are recorded at historical cost. They are never updated to the current market value or prices. Next statement is the income statement. Income statement is also known as the profit and loss statement. It reports a company's operating results for the period, which largely includes its revenues and costs. The income statement is used by analysts, investors, and it tells them how profitable the company is. In short, it can be summarized as revenue minus cost is equal to net profit. We have the structure of the income statement here. It shows all the line items that are there in the income statement along with their descriptions that we have. Absolutely, it starts with revenues and then includes removes the COGS from it to get calculate the gross profit. COGS, as you understand, is the cost of goods which have been used directly in producing the good or the product. SG&A are the selling administrative expenses which are not directly related to the production of the goods but still are very much essential for the business. We get EBITDA after its deduction, and similarly we get when we remove the depreciation and amortization we get the EBIT, which is earnings before interest and taxes. Similarly, when we remove the interest and the taxes we get the earnings or the net profits for the company. The third statement is the statement of cash flows, which tells us how much cash is available and what has changed the cash position over the year. for the company. This statement tells how much cash is entering and how much is leaving the company, how efficient the company is in generating the cash to pay out its obligations. The income statement only tells us how much profit has been made on selling the goods, but that does not tell us if the payments have been received and the cash has been realized. So, a company may have a very high profit, but if the payments are not made by the customers, company would not have any cash at hand to buy raw materials or pay out salaries. Hence, understanding the cash flow statement is very important. This statement only tracks the cash that comes in and the cash that goes out. Now, the cash is affected by three main categories, which are the cash flow from operations, which includes receivables, payables, inventories, the cash flows from investing activities, like investing in assets, like buying new buildings, sale of assets, and cash flow from financing activities. Let us now understand the constituent cash flows in detail. Cash from operating activities includes the cash generated through the operations of the company or through the sale of the goods. Examples, as discussed before, include accounts payable, receivables, inventory, depreciation, and cash equivalents. Cash from investing activities is the cash either generated or consumed through the sale of assets or purchase of assets, or payments made under M&A are also included into the investing activities. Third one is the cash from financing activities. This includes the loans that the company takes or the loans that it pays out or the principal that it pays out to the banks. Any payments of dividends or stock repurchases to the shareholders is also considered into financing activities. So that's all for today on the financial statements, and we will come back with more advanced financial concepts. If you like the video, do subscribe to our page. Keep following us. Thank you.